Welcome again to Curating Life with Ireti. It's been a long time, and I'm really excited to be back today. And today, talking about making your money work for you. This is very important. This is May. We're spending the first half of the year having fun and enjoying and stuff. So now, let's talk about something really serious. And I have an amazing person here today, and she's going to be talking about that, how to save, how to invest, what to do with your money, how to gain financial freedom. Don't you want to gain financial freedom? I really want to, and so I really cannot wait to listen to her. So stay tuned, subscribe, share, and also get your pen and paper and start to write, because you're going to learn really valuable stuff today. All right, so we're getting to the crux of the conversation today, and I have a very important person here today. My friend, the rich girl of Canada.
That's
the fire leader. Eniola Abiodun. This is a conversation that I really can't wait to learn from. Honestly, I probably need to introduce her, because I'll let her introduce herself.
Sure.
But she's my investment mentor and coach. Eniola knows a lot about investments, saving your money, how to make your money work, which is what we're talking about today. And so I'll let Eniola introduce herself, and then we'll get into the questions.
Sure.
One thing that I'd like you to know, at the end of this, you have an opportunity to ask me one question. It could be anything. It doesn't have to be about the topic for today.
Okay.
Anything. I don't have a choice but to answer.
Oh, so, fantastic. I like that.
All right, so introduce yourself and let's get started.
Okay, thank you, Ireti. My name is Eniola Abiodun. I'm a chartered accountant. I'm a tax expert. I moved to Canada about 6 years ago, and pretty much I've been on a fire journey for about 6 years now. And it's just really good to be here. It's good to see Ireti and just have a conversation around something that I find is very important to us. As Canadians, but generally as individuals. So Thank you for having me.
Amazing. I'm sure people are like, what is fire? So maybe you just help people know what's fire. What does fire stand for?
Yeah, so it's actually perfect time in the conversation to think about what fire is. So there's fire. Fire means many things, but in this particular context, we're talking about fire in terms of financial independence, retire early. And it just means, think about typical retirement. Typical retirement age in Canada is 65, but the FIRE movement, the thoughts around the FIRE movement is you don't necessarily have to retire at 65. So retire is not a number. Retirement is not a number. It's, when you're ready.
Oh my God.
And a large part of that readiness is financial readiness, but it goes way beyond that. There's the mental aspect. There's a lot of aspects around it. But I think there's a lot of conversations around the financial aspect just because, before you start to think about the other aspects, many times you have to deal with your finances first.
I hope my employer doesn't see this, but honestly, I'm ready to retire. So I wish I was fired. I want to be financially independent and ready to retire. And so, let's get into the conversation. I'm sure people are waiting to learn more about how can you even make that? How is that even possible? I know people that retire in their 30s, in their early 40s, and they just have fun and travel the world, which is what everyone wants to do, soft life, right? But let's start. Today we're talking about how to make your money work for you. And so what does that even mean to you personally?
Wow, okay. I like the way you put the question, making your money work for you. And when I think about making your money work for you, I think first of all about your values, like putting your money and aligning your money to your specific values. So making your money works for you is wide. So you could think about it in terms of you're a hard worker, you work very hard, you want your money working as hard as you do. Because your money can work 24 hours, 7 days a week. Your money doesn't need to rest, but you need to rest, So you can think of it in that sense, but you can also think about it in terms of your values. Okay, what do I value? I value contributions to my church. It's important that a portion of the money that I make
Oh,
goes to
that's
my
another.
church.
Yeah, that's another way to look at it,
So
for sure.
it's working for me because it's going to the things that are important to me.
Matter to you.
Yes, so that's kind of the way I think about your money working for you. I mean,
Okay.
most people would think about it in terms of investment.
That first one was what I was thinking about, honestly. But I think it's a good way, to also look at it like what do you value the most,
Yeah,
and how
think
can you
about
make
it in
your
terms
money. For some people they value shoes most. So how can I make my money to give me the best shoes? Or some people like
Exactly.
shiny things. I want to have the best car. If I'm working, then that's what I value. Some people
That's
it's how do I help other people, right?
That's correct.
And for other people it's just how do I plan for my future?
Yeah.
Right, which is what I was thinking about from
Right.
the topic when I thought about how to make your money work for you. But that's a good perspective. So what she's saying right now is whatever your value is, make sure where your treasure is, where your heart lies,
Exactly.
right? And so whatever your value is, where your funds should go
Exactly.
to, right? If you have the opportunity, because I'm sort of like, I wish my money could go to where. Now we're going to teach you how to make that money. So that you're able to, not even how to make the money, when you have the little that you have, how to make sure that you're able to multiply, to use it for whatever, it could be your values or whatever it might be. When did you first realize the importance of being intentional with your money?
That's a very fantastic question, and that's because I wasn't always intentional with my money. There have been times in my life when I wasn't as intentional as I am, and I guess intentionality is something that can grow as well. So I've also grown in intentionality. So growing up, I guess my parents were a huge part of growing up. They were a huge part of my life and my initial perceptions about money. And I grew up understanding that money is something that you spend. So when I got my first job, I wasn't thinking about saving, even though, as children, they would say, oh, make sure you save a part of your money. And I guess that's another thing they taught us, save a part, but it wasn't purposeful saving. It wasn't saving with a particular goal in mind. It was more, it's just a rule, like make sure you save something, So when I started working, I didn't, on the get-go, if I had the knowledge that I have today in terms of how you should use money, or how you should allocate your money, really, I would have done better with my money. So when I first started earning, a lot of my money was just sitting in my bank account, and then I knew some opportunities. So I did have ideas around things I wanted to do. For instance, I started working just a few years before I got married, and one of the conversations I was having with my boyfriend at that time, and then now husband, was I want to buy a house. So those were the kind of things we're looking for. Looking for opportunities. What kind of area do we want to buy a house? What is the price of houses in those kind of areas? How do we plan to work towards?
Can you all hear?
That
She was talking to her boyfriend about buying a house. So when you have a fiance, start talking about those things. We want to buy a house. It's not just an opportunity to just squander money and spend. Like, that's the intentionality around it.
Yeah.
And you might say that's too much because right now I'm just earning little, but still talk about it. Still talk about it. I think it's just intentionality around dreaming together, and even though she kind of looked like she had the money there.
Motivations, yeah. I think it's also good to know, like, just helping you understand your spouse to be like, how do you think about money, like how
exactly,
so just alignments.
Yes.
So we did have those kind of conversations. To kind of come back to your question about when did I get intentional. I think I got a new level of intentionality to money when we moved to Canada, because at that time we did have some cash that we wanted to invest, and knowing fully well that we had immigrated from Nigeria, I was thinking, this is a completely new environment. How do things work in this place? Like, what do you do? What do people invest in? Because I was coming from Nigeria where we used to buy treasury bills. We used to do, so there were these agricultural investments that we did at that time. So I knew that it wasn't going to work in Canada, and I knew we really wanted to move our funds to Canada. So I was like, what do people do to invest in Canada? And it was in the process of that I found out about the FIRE movement and found out about how to invest in the US and Canada. So I think I got a new level of intentionality at that transition point.
Yeah, no, that's amazing. You did talk about what you learned, how you saw your parents spend money, and what you kind of learned about money. And so,
Yes.
what role do culture and upbringing play in how we manage our money?
It plays a big role, for sure. I mean, I think we all know that it plays a big role because it's what you see. You know, what you see to a very large extent determines your thoughts. Like, and you know how we are said to be like the average of the 5 people around us. So, to a large extent, I think culture plays a role. I'll give you an example in one way that culture plays a role till now in the way that I live and the way that we live even as a family. You know, so debt is something debt is something that we've been very uncomfortable with. When we came to Canada and we knew the prices of homes in Canada, we're like, are you saying we can't buy? Like, there's nothing we can buy that we can buy like cash. You know, like, debt was just something that we didn't grow up with. I think coming from Nigeria where everything was cash based, like either you can afford it or you cannot. Like, loans were very rare, very maybe things that businesses got, or if individuals got it, the rates were exorbitant.
Exactly.
You know, so even until now, coming from that cultural background, I find myself very uncomfortable with debt, and I find myself always wanting to eliminate debt if we ever take on debt. You know, so I find culture playing a big role, and when it comes to upbringing, oh my God, that massive role. I'll give you an example. So my parents became financially independent, but not by penny pinching. So you'll see that in the fire community can be very big on managing your expenses, like not spending too much. But I didn't grow with my parents necessarily, you know, not spending too much. Like, they spent as they had. Not necessarily all they had, but as they could afford, as much as they could afford. You know, we didn't go to maybe cheaper schools because that's what they could afford, or they were trying to save money. They became financially independent because maybe business opportunities came that they came into, and then they made significant amounts of money in, and then were able to invest lump sums in. So that's culture, that's growing up in that way, because, you know, I didn't necessarily feature in their conversations, but I heard them speak, you know, on the dining table talking to themselves. I heard, you know, the kind of conversations that they had around money, and I knew that even though they were different. So my mom was a little bit on the more of a saver than my dad. Yeah, she's more conservative for sure than my dad is, and he is more of a spender. He's also more of an optimist. He's also more of, you know, that go-getter kind of you know, someone who wants to, you know, he's like, it's going to work, like, I'm going to make money. Like, you know, some people are very bold and, you know, so he's more of that kind of person. And, you know, just seeing them and how they manage themselves, how they manage money, and, you know, that played a big role. And I think partly why my fire journey didn't start as early as it could. So, I mean, my fire journey not in terms of income, but more my fire journey in terms of managing expenses. I wasn't necessarily big on managing expenses because I'm not naturally so. But, you know, coming and actually knowing there's a movement, and this is what the movement preaches, kind of helped me to say, okay, there are ways that you can, you know, still have a good quality of life, but, you know, also not spend as much.
Spend as much as you want to.
Yes.
No, I totally agree with you. We probably might not see we probably might not be in conversations when our parents speak, but we hear and we kind of see.
Yeah.
And so if you are, as parents, once the new iPhone comes out, like, you all just want to get it. Your kids are seeing it, and for them, they feel that's how, you know, to live your life and to spend your money. If you spend your money every single time, you know, I've heard someone say, the reason why I feel like I don't have money is because I always hear my parents say they don't have money. So even though I have money now, the first thing that comes to my mouth, when someone asks me, my first response is, I don't have money. Right? And the person said it in Yoruba, and so yes, follow me.
Yes.
Because even though you have money, but that's what you hear. And so that's why I thought kids actually do hear when you say things. They watch you and they learn from it.
That's right.
And so if you are, as parents, you invest, you save, you know, you're modest with how you spend as well. Right. And your kids can see, and you even tell your kids. Correct. They become better financial, except what do they call them? The next of kin that spends your money on Tesla. They are good next of kids that know how to, have, some financial management capabilities. That's very good. So let's get into it. So how can someone that is living paycheck to paycheck start building a financial cushion?
A financial cushion. So someone who is living paycheck to paycheck first needs to get to that point where they desire to not live paycheck to paycheck, because that desire is going to be the driver. Because like managing your finances on a day-to-day can be very boring. It's not like you're doing anything special. Like you get to a point where there's really nothing you're doing, besides of course maybe new opportunities to make income that might be different from the ones that you're currently exploring, those kind of things. But in terms of daily management of what you have, there might not be any change. But by the time you automate things, you've done a lot. It can be boring. But you need to get to that point where I'm like, okay, this is unacceptable and I need to change my life. I can't be living paycheck to paycheck, and this is my why. So defining why you don't want to live paycheck to paycheck is very important. Personally, like freedom is so important to me, and I'm sure it's important to many people, but not everybody sees the fact that it is even possible to be free in terms of you wake up on Monday morning and you do whatever you like with your time, so because of that, I make sure that like as a family, we make sure like we're widening that gap between what we earn and what we spend. So someone who is living paycheck to paycheck needs to first of all make that decision. Second of all, start to educate yourself. It's a process and it can't happen in one day. But watch videos. There's so many podcasts, so many YouTube videos. I mean, this is one, for instance, where you get so much education about what you can do differently. So start to educate yourself. Once you start to educate yourself, then you want to start to prepare a budget. You want to know where your money is going. It's when you know where it's going that you're like, maybe it doesn't have to go to this direction. Exactly. Maybe we need to reduce this one or increase this one. That's when you now start, making those decisions about how you manage your money. So when you start to make a budget, then you now start to keep that difference. So when you make a budget and you see that what you spend is exactly what you earn, or what you spend is even higher, then you now start making those changes. Then when you make those changes is when you now start having that difference. Oh, there's a difference. I spend 5K, but I earn 10K. So now what do I do with the 5K? So when you start having that difference, then you're like, okay, you're not going that paycheck to paycheck. You're now getting to the point where, what do I do with that difference? But at least you've left the point of, every month, you're you're waiting for the next paycheck to spend, So I guess that's pretty much where you start from, that desire, the education, then of course
getting to do it.
Budgeting, yes.
And so we've heard about, what percentage of your income should you save, should you invest? I like you to go into, you believe people know it, but people might not. Right? And so if you can go into detail as to how you actually spend your money.
Right.
How you should, like guidelines. She's not saying this is how you should spend it every month, but there are guidelines around it if you really want to get to a point where you have enough money to live the life you want to live.
Right.
Yeah.
So personally, I'm not very big on percentages. How you commonly hear people say maybe 50% to your needs, 30% to fund money. Sometimes people would allocate percentages, but personally I don't allocate percentages, and that's because I think there's life is in phases. When we came to Canada, using that as an example, our daycare bills were in excess of $3,000. Not just daycare, before and after school. So we had 2 kids in daycare, we had 2 kids in before and after school. So we're paying quite a lot at that time in childcare expenses, and it's not so today. So if we had a rigid, this percentage has to be allocated to childcare, then it's not necessarily helpful to us. It's more, are we putting our money in, are we making use of our money in a way that's most maximally profitable to us? So let's say, for instance, we earn 5K, just to use a simple number. If we earn 5K and we spend 3K on childcare expenses. Are we of course we're
Yeah,
not,
of course, that's financially wise.
Yeah, it's not it doesn't make any sense in that sense. Well, of course, in the short run, it could make sense, in a situation, for instance, where the husband is working and the wife is taking care of the kids. In that case, you don't even need childcare expenses. So it still doesn't make sense. So okay, maybe that's
the wife is schooling.
Oh yeah, maybe schooling and
she's
needs
schooling.
childcare, yeah. So but even when you're schooling, sometimes you have aid to support that.
Yeah,
so
true.
I'm not sure that's a good example, but there can be times when something that is maybe unwise in one situation is wise in a different situation. And I guess an example would be maybe the woman is maybe just getting back to work, and maybe her pay doesn't even necessarily cover all the childcare expenses. But if you look at how she can grow her career maybe 10 years time, it does make sense to make that temporary adjustment. So I think I like Ramit Sethi and the way he encourages people to spend money like lavishly, use lavishly, but lavishly is very it's subjective, like it's not a number, so be careful about that word lavish, because there are times in your life when you should be lavish and there are times when you should maybe be less lavish, so spend on things that you value, things that make sense to you, things that make a positive difference in your life, without having a negative impact on your future, because there's a part of our money that we allocate to our future, which is investments, right? So we don't like. So another thing about expenses is there's a limit to which you can reduce your expenses.
Of course.
Because there's a minimum quality of life that either you are used to, or that you desire, or that you want. Let's just put it that way. There's so much you can do to minimize. Of course, yes, there's a lot you can do. You can probably move your expenses from 8K to 5K without reducing the quality of life. There are certain moves you can make that would still keep you in good shape. But you're spending less, but then there's no upper limit to how much you can earn, and so that's why it's a better focus, it's a better place to put your focus on, like, how do I expand it? Because we're like, oh, this is the cake. Yeah. How do we make a bigger cake, as opposed to how do we share this cake? So
just to ask, so when you say there's no limit to how much you can earn, people make a lot. There's some people that make a lot of money.
That's right. And
they spend it all.
Sure.
Right? And so I think going back to the question around, and I remember you taught me this, build an emergency fund.
Right.
Start to save some amount of money.
Right. Start
to pay back your debts.
Right.
I think it's the 101 of how to gain financial freedom.
That's correct.
And I think people want to hear that, because
that's correct.
Some people are just like, let me just spend. I'm investing. Let me just buy this. I want my kids to have. But then they're really spending everything they earn. And no matter, the thing is, the more money you come across, the more problems you see.
That's right.
Your pay can increase from 5,000 to 8,000, and then you realize your expenses have increased as well, because your taste will also. That's when you realize we have never gone on vacation. We want to go on vacation.
Time.
My kids need this for exposure, right? And then you realize you're spending it all, and it keeps increasing. You keep spending. It keeps increasing. You keep spending. It's like the anxiety that
there's no end.
That song that talks about anxiety and following you, like at the minute you spend, the minute you earn more money, except you're intentional.
That's right.
About how you actually spend your money and put your money to work. So let us know. Tell us about it.
Okay, so I think I would kind of backtrack a bit to your question about paycheck to paycheck.
Yeah.
And someone who is really good when it comes to someone who is helping people come out of debt, or helping people who are living paycheck to paycheck come out of that cycle, is Dave Ramsey. Like, I know,
Dave Ramsey.
I don't.
Does he have like a podcast?
Yes.
I know there's a lady that. Dave is the man, right?
Dave is the man, yes.
There's a
he has a
that
daughter that works with him.
They run the podcast together.
Yes, they do.
Oh, she's very strict and very.
He is as well.
We take like calls and people talk about. Oh yeah, I do watch her. Sometimes I'm like, stop talking about me. And I change and move on from her. Don't stop talking me about
there are
this.
things like Ram say, there are things that I don't agree with him. You know, so for instance, he's very into not using credit cards. I'm not necessarily like big on you don't use credit cards at all. I mean, right now I'm actually on a cash spend. Like we've been spending cash for more than half a year. I'm really happy with it, you know.
But you don't really need your credit anymore for anything significant, right?
It's not even that. It's because there's no change. Like my credit score has even increased ever since I started using some credit cards. You know, like so. I don't really think that people should not use credit cards. You know, there are benefits to using credit cards, but then credit cards are not for everybody. There are people that credit card will make them spend more, and even on average, even people that are disciplined, you probably spend more if you use a credit card versus seeing that money.
Forget to return the money back, and they will tell you what you don't like. I'll spend this money.
Spend so much, yeah.
Oh yes.
Yeah. So there are things like he says that I don't necessarily fully agree with, but when it comes to helping people not live paycheck to paycheck, helping people get out of their debt, he's good. And his principles is his first. So he has something called baby steps, and his first step is just save $1,000. Like, how hard can that be? In fact, just canceling some subscriptions, not eating out, like just making small changes, you can save $1,000, right? So his first step is save $1,000. You know, so when you save $1,000, and then he encourages people to then save 3 to 6 months. So emergency funds are just like rainy day funds. It's like you acknowledging the fact that you don't know the future. It's you acknowledging the fact that you don't know when the rainy day will come.
And faith is okay.
Yes.
God is by tomorrow.
Yes.
It's okay to do that.
Yes.
But also you have to be wise, right? So for those that are saying, don't worry, that's what happened to me, Jesus saying, you know, I have faith, you know, because of him I can live to. We are Christians.
That's right.
And we also have that faith.
It's not necessarily, like when we say emergency fund or rainy day fund, so maybe emergency is maybe too negative.
I think it's just
the way some people don't like the word project. They're like, oh no, let's call it a spending plan. You know, like whatever makes everybody happy, right?
Sleep at night.
Rainy day funds is not necessarily an emergency that you know you have to call 911 It could be as little as you know your pay comes maybe at the end of the month and then it's delayed by 1 week. You know, but you're not bothered because you have a good buffer. So that's really helpful. So 1,000 is like just like a bare minimum like everyone should have. And then when you get to that 1,000 mark, then you want to buff it up to 3 to 6 months. So let's say for instance
6 months of what?
Of what you spend every month. So let's say for instance you spend 5K in a month. So if you spend 5K in a month, then you want to at least have 5K in your account. And then at some point you have 10K and then you have 15K. So if anything happens that you can't work, so let's say for instance you lose your job, or you just have a bad boss, or you're just needing a mental health break, you just need to take time off work.
Right.
You know, one thing or the other comes up and you just need time, you're not like worried about. And the bigger that fund is, like imagine you have 3 years worth of emergency fund, which is probably a lot for someone who is not yet retiring, but you're just using an example, like even let's say 1 year. You know, you're not really worried about.
That would be great.
You comfort, a really good, comfortable place to be. You know, so if you think about it, so it's really good to build that base. And kind of what you said about some people have very good income, so some people might be easier for them to build that fund than others, and that's why it's very important to build skills that are sellable, that you can, you know, use to earn a bigger income, and then therefore you don't find it hard, you know, the gap between the expenses and your income is significant enough so that you have more to invest and you also have more to save, you know.
That's amazing. So what I hear you say is start saving at least $1,000, and after that you need to build an emergency fund. So let's assume I'm done. Now I've built my emergency fund and I have it. What next?
So it depends on your goals, and that's a good question. It depends on your goals. So personally, when I found out about the FIRE movement, it became that big goal, like that long-term goal. You know, getting to that point where, FI meaning that you're at the point where your passive income exceeds what you spend. So, and generally the FIRE movement defines that as where with a 4% rule, and 4% rule meaning that if it The 4% comes from a study, really, a study that's explored a lot of retirees and how they spend their money, but it's pretty much saying that if you have what you spend every year in 25 places, so let's say for instance you spend 5k, it means that in a year you're spending 60k. So if you have 60k in 25 places, as an investment, the outflow from that investment is more than enough to last you your whole life. But that there's an assumption that you're not inflating your lifestyle, like you're not increasing what you spend monthly. Is also if you think about the risk-free rate right now is around, so if you think about US Treasury bills, depending on the length, so let's think about 0 to 3 months Treasury bills, those would earn somewhere between 4 and 5%. And so if you think about even the most conservative investments, 4 to 5% is not hard to get, such that if you have that kind of money as investment, so 60,000 times 25, whatever that number is, you can spend your whole life doing what you want to do. You can say, for instance, I want to go to Africa, I want to go and volunteer my time in Africa, or you want to, like, pretty much, like, there's no
$5 million. 60,000.
25, so 25 in
6 times 2 is 1, that's
in
200.
4 is 100, that's 150, so 1.5, yes.
Yeah,
1.5 million. Yeah, so if you have investments worth 1.5 million, then you're good to go.
You're good to go.
And the rule of thumb is for every $1,000 that you spend in a month, then you need 300,000 worth of expenses of investments to cover it. So that means if I was a young bachelor and all I spent is 1,000 in a month, I only need 300,000 worth of investments. But the more
$300,000
in investments.
Why?
Because that's 1,000 times 12 is 12,000. 12,000 times 25.
Of investment for retirement.
Yes.
Okay, you scared me. I'm like, what?
Like,
for every 1,000 you need 300,000 for investment. Like,
correct.
for people that spend like 12,000 every month, that's like how much? Okay, for retirement.
Yes.
So that makes sense now. I've heard people say, very recently, I've seen a lot of things on social media where people have said abroad, you can never become rich because you have bills to pay. Bills, there's mortgage, you get a car, you have to pay for it because you probably didn't pay cash down.
Correct.
There's so very many things. And so now, assuming I've saved around 1,000, I have an emergency fund.
Yes.
Right, I'm beginning to invest. What about the debts that you get a mortgage and sometimes 20 years, 25 years,
Yes.
when you pay back.
Right.
And someone who's already 40 that gets a mortgage, that means that at retirement you're just paying, you're just paying off your mortgage, right? And so what are your thoughts around how to pay your debts? You talked about credit cards earlier.
Right.
There's some people that have really a lot of money on their credit cards.
That's right.
To pay back, and they also don't think about the interest rate on credit cards versus like interest rates on people want to pay down their mortgage, but then they have high credit.
That's
so
right.
talk about that, because you've told me about that before. Like,
Yes.
we've had conversations about that. So I think people want to.
I think that ties back to my lack of comfort with debt. I'm not very comfortable with debt, so I tend to encourage people not to be in debt. And I also kind of touch on what you said about in this part of the world, sometimes you find that the distance between your income and your expenses is not that much for you to build a large asset base. So let's start with debt. I like that one because I think it's something that people can easily avoid. Credit card debt, for instance, what we do is encourage people to not take on more than, so basically you're spending what you have. So if, for instance, you have $2,000 in your account, and maybe your budget is $1,000, you're not spending more than that. So your credit card is just you're just using it as a stopgap. Exactly. It's not that you're spending what is not sitting in your account, So encouraging people to use it in that way. Also, when it comes to like car debts, that's a very, very popular debt. Also, we just encourage people to buy cash. it means that it might mean that you're not buying the finest car. It might mean that, and it doesn't have to be like that forever, because your income, your pocket's not necessarily the same all your life, right? So, but as a newcomer to Canada, you don't necessarily have to buy a brand new car. You can choose to buy a car cash down. I know, like, people who bought their cars less than $5,000, people who bought their cars, $15,000, money that they could actually pay, as opposed to having to do a car loan.
At this time, when dollar rate is not really high, people are like, if I want to buy a car worth 5,000, that means I'm spending 5 million naira on a car or more. Say 6 million naira.
Right?
And don't forget that you pay mortgage, you pay your rent monthly as well. And people are like, you know what? Like, I want us to look at the realities of today.
That's right.
Right? Except this person is making so much money already in Nigeria. They have
also,
a lot more.
Even 5,000, like, I'll tell you what, like, I have a friend who bought a car less than $2,000, the first car
really?
they bought, and this was even someone who could afford much more. They bought a car at less than $2,000. It was a family car, for that matter. It was like an SUV. It was a dated one, but it actually served them well. And at the point they were selling it, they sold it as much as they bought it for. Yes, yes. So I think learning to cut one's coat according to one's size is very, very important. And it's not easy, particularly when we come from a place, and sometimes when people relocate to Canada, they feel like, whoa, I can finally live
the life that I want to, that I've always dreamed to.
Right, but you can also do it in phases. Like, the fact that you bought a $1,000, $2,000 car does not mean you have to use it forever. You could use that car for 1 month and 2 months, and you get to a place of abundance where you're able to afford more and do more, right? So,
so pay your credit cards, pay your car debt.
Exactly.
What about mortgage?
Yeah, mortgage is a big one. Mortgage is a big one, and that's because most people take mortgages in hundreds of thousands of dollars. And many people don't realize that you don't have to pay, because in Canada, for instance, mortgages are typically 25 or 30 years. In the US, you find people are able to take on 15-year mortgages.
Oh, really?
Yes, but in Canada, it's just like, I haven't seen banks extend 15 years to people. In the US, people are even encouraged to do that because you get lower interest rates, because the time to pay is much lower. But in Canada, it's different. So in Canada, even there are ways that you can ensure that you're not paying your mortgage over 25, 30-year periods. So one way to do that, for instance, is just by paying your mortgage bi-weekly. So just switching from monthly payments to a bi-weekly payment reduces the amortization. That's like if you did nothing. Another way that you can do it, most banks, or should I say most financial institutions, because some people take mortgages from like mono lenders and credit unions.
Bi-weekly would be the same amount you pay monthly.
Yes.
That's like double the amount in a month.
Oh no, so what they do is they take what you pay monthly, they
spread it over 26 weeks.
Spread it over 26 weeks.
And if you did monthly,
so they will multiply your monthly by 12 to get the annual, and then divide by 26. So you're still paying the same.
You're still paying.
Yeah, but because you're paying it more frequently, even though it's slightly more frequently, it reduces the amortization a little bit. You might, depending on your interest rates or on how much your mortgage balance is, you might see your amortization drop 1 to 3 years, but there would be a change. So if you were in a position where you couldn't increase how much, because really how you pay down your mortgage is by putting in more cash, right? If you're in a position where you're not able to put in more cash, the littlest thing, like the most basic thing you can do is just switch from a monthly payment to a bi-weekly payment. Also, most financial institutions in Canada allow you to switch your payment frequency to an accelerated payment frequency. In Canada, there are 2 types of accelerated frequencies. There's accelerated bi-weekly. There's also accelerated weekly.
What does that mean?
So instead of them to multiply by 12 and divide by 26, they just divide by 12. So which means you're paying slightly more. Yes.
But isn't that a regular paying by, if you pay monthly, isn't it by 12?
Oh no, so if you're on accelerated weekly, you're paying weekly.
Oh, weekly.
But the way the accelerated weekly is calculated, it increases, so it's like taking so let's say it was bi-weekly, accelerated bi-weekly. Accelerated bi-weekly is just taking your monthly payment and dividing by 2 or so, I think. Because then you're paying slightly more.
Oh, you'll
pay more, but you're just very slight.
Yeah,
but you'll be surprised that slight increase can reduce your amortization by 3 to 4 years, sometimes even 5 years, depending on
Nice.
the balance and the amount and the interest rate. So, that's another change that people could do. Another one is just putting an extra $100. So let's say, for instance, in most financial institutions, and now you put an extra payment. So on every payment you make, most financial institutions allow you to put an extra. Usually that extra is capped. And usually it's capped by, let's say for instance, your monthly mortgage is $1,000. Okay, let's say bi-weekly. Your bi-weekly mortgage is $1,000. That $1,000, usually you can pay up to another $1,000 on it. So depending on how much you save, let's say for instance you cut off subscriptions and the subscriptions you cut were $100. You can say that $100 I will put it on. So instead of paying my $1,000, I will pay $1,100. And that would shave off years of your mortgage, because you're paying more rapidly, right? So a greater portion of what you pay is going to your principal. So the most important thing is that you're doing something positive with your money. So whether that's paying down your mortgage or investing into your future, just do something that positively impacts you. And you always want to measure as well. That's something I also encourage people to do, that on a quarterly basis minimum. Of course, if you want to do it more frequently, let's say for instance you want to analyze your expenses every month, do it, but at least on a quarterly basis, so that you're not forgetful of what did I spend. Look at your finances on a quarterly basis. Determine your net income. Determine your total expenses, and also their net worth. Their net worth being the difference between their assets and their liabilities. For example, like I expect that by 40, in my early 40s, we should be fully financially independent. And I think to myself, like, at 40, some people are just starting out their lives. So it's less painful for me to say I will make that sacrifice now, because I'm not like cutting my life short. So like I'm not not living my life, so to say, because between my regular retirement age is 65. So if, for instance, I retired early at 45, let's say, or 40, and in my mind I'm like, that's like 20, 25 years pre-retirement.
But that's also assuming. That's also assuming that at 45, unless I never say let's put faith aside, because faith is always there, right? Yes. But that's also assuming that you have the health to do all of those things.
Yeah, I think
that's also assumes that God is expecting you to live beyond that time.
Yes, so I think I expect to live beyond that time. Like, there's no part of me that is like, what if?
What if?
I'm not in that space where, like, there are times in my life when I'm like, what if? What if this? And I guess it's kind of come back down to our faith. If, let's say, for instance, Jesus lived for like 40 years, right? He probably knew he was not going to be on earth for 100 years. But if you feel like all other things being equal, of course, Jesus can come. Jesus can come next year. Jesus can come in 2 years' time. All other things being equal.
I'll give you an example. I used to be right from uni. I was always focused. Mm-hmm. Like I didn't have time to play at all. Like I was always reading.
Serious student.
Like 18 hours at a stretch, kind of reading person. And then when I started working, everyone knew that I was a workaholic. I would work Monday to Sunday.
You didn't take a break.
Even when I did not have to. After church on Sunday, I'm at work. Yeah. On Saturday morning, I'm at work. Till 9, till 11,
when you
till 12.
graduated and started working, you didn't necessarily have the financial education.
Oh, I'm talking about working now, not even school. Now, I've left school and I'm working.
No, I even mean, like, let's backtrack. Because what I find, Ireti, is that in this FIRE journey, time is your friend. And generally, people tell you that when it comes to investing, time is your friend. Imagine you knew about FIRE and you had the education that the movement gives, like at the age of 13. At that age, you're probably babysitting. At that age, you're probably not even doing anything. Maybe some people at 15, 16, they're working in McDonald's, or maybe some people work, like very popular that people would work as swim instructors or camp counselors. But they're earning money. But at that age, your parents pay all your bills. So imagine from age 18 to age 28, that's 10 years of all your bills, all your income, is investable.
For an African child, not white child, because at 18, they move out of their parents and start to pay bills.
No, that's the funny thing. exactly. Like some
A lot of them, not all of them.
I'd say less than 50%. Some parents even rent out their homes to their children, not necessarily because they want to, but because it's a tax planning move for them. So that therefore they have a part of their home that is an expense, that's a business.
We'll talk about that later.
Later, exactly.
We'll talk about that. Not in this call, after the shoot. Sorry, guys.
Okay.
I had a question that popped up in my mind. I'm like, not for now.
Okay.
So what I was actually trying to say was, I worked so hard, and then every time people were like, you need to relax and have some fun. You were a single girl. I'm like, never mind, when I get married, I'm going to have time. Like, wrong. So, don't worry, I'll do it. I just need to. And I kept working that hard until I got married. And fortunately, I had my baby in the first year that I got married. And the dream and the aspirations of traveling the world disappeared.
No.
Which is why right now I'm like,
this is the time
who
to
says?
Yeah.
When I keep saying, don't worry, when I reach financial independence, I want to retire early. Who says that I would have the capacity to do that at that point?
Right.
This is just me. There's some people that have that mentality as well. And I said that because of what you said off camera.
Right.
So people might not understand why we're having this conversation, but it was based on what you said off camera around, I don't want to go on vacation, I'm just going to make sure I pay all my debts, and then later, when I retire, the question is, who says there's going to be a later?
Nobody promised you tomorrow.
Exactly. Right? And that's just the headspace I'm in right now. It could change in another 4 years after I'm done traveling to all the places on my list, and I'm like, okay, I think
also is there's YOLO, right? So there's a YOLO movement, like you only live once.
Sense.
Yes, and many people. In fact, I was reading an article, and the guy was like, "I really expected to get hit by a car or die somehow, but then what happens when you leave? So if you leave and you manage your expenses expecting to die, I mean, in this part of the world, life expectancy is 85.
So you will leave.
You are going to leave.
You will leave.
I mean, in Nigeria, life expectancy was 50.
Yeah.
So I think that thinking about it here, you're more likely to leave.
And it's tougher when you stop working and you don't have the capacity to work anymore. Because you still have to pay the bills.
Right.
You still have to pay for all the expenses.
Exactly.
And if you're lucky enough.
Life expectancy being 85. Think about that. That number factors in that a very minute percentage died at 1 or at 2, at 3, at 4. You that you are alive, you are likely to live to 90, to your 90s. So that average, think of it that 85 is an average.
And if you're lucky enough, let me say lucky, to have kids that will say, you can't stay in my house because you're stressful. You're going to have to stay in a retirement home.
You don't even want to stay.
You're going to pay the bill. Because a lot of people still pay their bills at retirement homes, right? Because their kids are like, we can't afford to do that because we can't even pay our own.
And even if you get yourself in a government-sponsored retirement home, one thing I found with retirement homes is that they're in levels. Just the way people say, life is in phases. Men are in sizes, life is in phases. 5K per month retirement home. The enjoyment of it is not the same as 10K per month retirement home.
But it's 10K per month retirement. Save. And so see, the days I go to work, and I'm probably digressing. The days I go to work and I take food from home, I know how much I save, right? So when you talked about expenses earlier, the coffee you buy every morning, I don't take Tim Hortons. I don't take Tim Hortons. I take Starbucks, and you buy the $5 coffee from. Multiply that by what you spend in a month, and you invest that into ETF, for example.
Just put in the S&P 500, for instance.
I was going to talk about investing. I was thinking that we don't have time today, but quickly.
Okay.
And this will be my second to the last question, because I want you to round up with something that people will say, does she think that she knows it all? Does she think, and I want to ask a question, that will help you round it up. But in terms of investment, a lot of people are not, they're not educated. You are so I have a sister who's an investment manager in the UK, and she pulls my hair from there and tells me, have you done this? Have you done that? Aside her, the second person that would call me randomly, why are you investing? I'm like, last couple I was completing your 8 months. Now she will come and she will ask me, where are you investing your money? What are you doing? Is it US fund? Is it ETF? Is it differentiated share? What is it doing? I don't kind of help because it gets me thinking afterwards, and I'm like, what exactly am I even investing my money in? So people have basic knowledge of, I want to invest my money, I want to buy shares, I want to buy Google shares, I want to buy something. Can you spend 1.5 minutes just talking about how to invest?
Okay. I guess when it comes to investing, you want to think about 4 things. First thing is, how much time do I have to manage that investment? You want to think about your investing timeline, for how long can I need this money? There's money that you don't need in 2 years, and there's money that you don't need in 10 years, and there's money you don't need in 20 years. So it depends on where you are allocating that fund to, how long do you have to invest. So someone who is starting to invest or starting to invest for retirement at age 50, the kind of advice, the kind of things you ask them to put their money in might be different from someone who is 20 years old. So those kind of things you want to put into consideration. So don't think about your investment timeline. You also want to think about your risk profile. Some people are more conservative. So the question is, if your $100 became $70, would you be I'm going to buy more of this investment? Or are you going to be sell it off? Or some people won't even wait till 70. When 100 becomes 99, they're sell it, I can't deal. How much volatility are you comfortable with?
Yeah.
Because sometimes you find that there's a relationship between the risk and the return portion of your investing. So those are things you want to think about. You also want to think about, what kind of investments do I want to do? So what kind of investment opportunities am I open to? So for instance, in Canada, in the US, I'd say US and Canada because a lot of Canadians invest in the US, right? So in US and Canada, we can invest in real estate. We can invest in the stock market. We can invest in private equity. We can invest even in, treasury bills. We can invest in so many ways. We also invest in businesses as well. So when you think of businesses, of course, when you invest in the stock market, you're investing in businesses, but sometimes you can invest in a small business, a business where you probably have more direct control over. So you won't think about investment, what kind of investment you are most comfortable with. As a person, you also want to do a lot of research because you want to do what makes you sleep well at night. You want to do what, you wake up in the middle of the night and you're left and right. So those are things that you want to think about when it comes to investing. You also want to think of how much am I able to invest and how frequently am I able to invest an amount. Because there are some funds that are locked in. Some funds, there are private equity funds, for instance, that you cannot invest maybe less than $20,000, or your assets, your net worth has to be a certain amount for you to even be have the opportunity to invest in those assets classes. So there's quite a number of things that you need to really think about. In just 1 minute, thinking about there's a lot that we can dive into, but those are things you want to think about.
There are many apps that you can use. Introduce me to Questrade, Wealth Simple. There's so many apps that you can use to.
But it also depends on what you're investing in. If for instance you're investing in real estate, you're not even thinking about Questrade. So you don't think about Wealth Simple. That means you're thinking stock exchange, right? If you're thinking about the stock markets, then you're thinking about apps. All the big 5 banks have investing platforms that you can invest in. There are smaller investing platforms as well that you can use as well. So those are things you want to think about in terms of the cost of investing exactly. So you want to keep your cost of investing to as as little as possible. So that's things you want to think about. So I would invest in this, but I want to invest in that. You think about your age, I guess. Sometimes your age even also affects your risk profile. You find that maybe boomers are more open to some things that Gen Zs are more
open to doing because they have more time.
Exactly.
If anything happens, they have more time to start over again.
Correct.
Imagine investing your money at 59, everything crashes. Your life is almost over, right? Okay, before I was going to say some things, just to round up. But yeah, also make sure that you're paying into your RRSP, your retirement savings plan, your for your children's education as well. I know Eniola is of the opinion like I'm going to take the money myself and invest it in something instead of using. So yeah, it depends on how.
So that's like another thing to consider in terms of your tax preferred accounts. Or you want to maximize your tax preferred accounts before you maximize or you start to invest in your non-registered accounts. But there's a lot, like we can't cover that.
We can't cover that here. So I'll put a link to that on the channel so that you can follow, connect in your life if you want to learn more about all of this. It's not something you can. I'm learning this for how many years now, so it's not something you can learn in 1 hour or 30 minutes.
Okay. Be in a position where you need to sell your investments and market it down.
We grew up in a place where, your retirement plan is your kids. Retirement plan.
So we've come a long way from that.
We've come a long way from that. I know your retirement plan is your kids. So I'm investing my life, and honestly, to be fair, parents invest their lives into the kids. Like here, some kids have to get loans to pay their school fees and university. But back in Nigeria, your parents would pay your. When I tell my friends that, my parents would pay my university fees, and some parents even pay for masters, some even pay for PhD for the kids. So they invest in everything because at retirement they're expecting that you would have to fund their lifestyle, but. Don't rely on Gen Z. Gen Z, don't rely on them. I love Gen Z, but it's changing.
Gen Z thing.
It's changing.
Generally, you should have a retirement plan.
Oh, you should. Yeah, exactly.
You want a retirement plan that you have some level of control, but your kids, they have the right to spend their money as they will.
Oh, of course.
They don't want to depend on them.
They don't want to depend on them because if that chair is pulled from under you. So what I've heard from you today, and I'm not going to go into summarizing everything, but I think what was most critical is, determine what making your money works for you means, like from a value perspective or from where you want to invest your money or use your money for. I've also heard you say start small. Right, start with $1,000. It might even look big to some people, but it's okay. Start from where you are. Make sure that you have emergency funds. Make sure that you start to save. Make sure that you start to invest. Do your research. Save. Soft life is not only when you're retiring. There's soft life too because there's $1,000 retirement home. I'm not sure there's even $1,000 retirement. We kind of start. I see it start from like 3-5. I see it across. But there are different levels of retirement home. You don't want to be retiring and then you're uncomfortable. I haven't worked all life and now it's time for you to rest from the work. Right. A lot of people are looking forward to retirement because it's a time when I don't have to go to work every day.
You actually want to retire and be able to afford the care in your own home.
In your own home, exactly. Yeah. You want to afford it, and then if you cannot afford it, then you're wondering, what exactly did I spend my life doing? And if you do not have kids that are also invested in making you comfortable, if you are lucky enough to have kids who say, you know what, I want to take care of my making my money work for me is taking care of my parents because they were there for me.
Some people might feel that way.
Some people, exactly. If you don't have that, then you're kind of stuck. So please do save. Save for the future, invest, pay your debts as much as you can. Like follow Dave Ramsey. She talked about Dave Ramsey here and learn how to pay your debts. That's very, very important. Yola, this has been really amazing, not only for for everyone listening here, but also for me, right? Just like a clarion call to kind of go back and check how much I actually do spend every month, and the little times that I want McDonald's today, I want this one today. I tell my kids we're paying debts, we're paying mortgage. There's no McDonald's today. I hope they listen to me when I tell them that. But yeah, like all the time. Honestly, my kids do it all the time. As soon as I go and I come back, they expect me to bring something back. And they also have to learn that you don't have to spend everything that you have, which is what I'm teaching them. And I have apps for them where I've told them that I will start paying them money to do things, but I haven't started.
Okay.
And they keep asking me every day, including this morning, where is my son yesterday said, I've cleaned my room, I've cleaned the home. That's my little one. I've cleaned the room, I've cleaned the home. I've done my laundry, I've folded my clothes. Can I get my $1 million? I'm like, ooh, I wish that I got $1 million. But at least they know that you work and you earn. And I really want to teach them what do you do with that money that you earn? You don't just take the money to go buy a wristwatch, right? You have to invest and save. So I really appreciate it. This is your opportunity. I've been asking you questions since. Any question?
I get my chance. Yay.
Yes.
Okay, so the question that comes to mind is, what is your fire number?
Hey!